the personal credit game is getting played out. Now, I've seen some alarming statistics over the past several months, and I work with a lot of different fintech and credit card issuers. And one thing we've seen is that approval rates have decreased, especially amongst the subprime credit category. Now, let me just jog your memory a little bit on some of the recent personal credit cards that have either been canceled or are struggling. So as a lot of you guys remember, the Tomo card, right? So the Tomo card is no longer a credit card. Now they're offering some type of trade line, but not an actual MasterCard that you can use or swipe. Now, a lot of you guys do remember the Sable card. This was a fintech card. It had a lot of promise. You know, you go on their website, and as you can see, they've concluded their operations, no longer accepting new account applications, right? And so this was very short-lived. Going back, Vital Card, this was another, fintech credit card. They just recently issued cards, I would say probably about 8 or 9 months ago, to a lot of beta users. And then recently they sent out notifications that they're terminating their credit cards, right? I was a strong proponent of this. This was one of the credit cards. It was like a hidden credit card. It didn't report. But as you can see right here, that they're winding down their consumer deposit and credit card programs over the next 30 days. So this credit card is no longer available. So a lot of you guys remember the BlockFi Visa. So you go on BlockFi Visa credit card website, it no longer exists. Nest, which are another credit card, grand opening, grand closing, right? ONU didn't really get off the ground. There was talk about the Celsius credit card that never came to fruition. Some of these other ones, Bank Mobile, no longer available. BBVA, no longer available in the US. You had the Grain line of credit. They're not accepting new applications. And then Rocket Visa. So I actually speak with a lot of different brands, and a lot of brands reach out to me to promote their cards. What I've communicated to a lot of these brands is that right now it seems like a lot of consumers are just tapped out, right? Like they can't take on any additional credit. You have credit scores that are starting to decrease. Consumer debt is at an all-time high. One of the recent ones was Rocket Visa. Now, this isn't necessarily a subprime, but they're actually struggling on getting conversions. Now, I know there's some other YouTubers who promote this, and I did talk to some representatives, and they were saying to me that just through their Facebook ads campaign, they're only getting a 1% conversion. So for like every 100 people who go through the pre-qualification, only 1% is actually getting approved, right? So extremely low. So a lot of these companies are starting to struggle. But let's paint a picture for you. Now, this was a report that came out not too long ago. Household debt reaches 17.5 trillion in the fourth quarter of 2023, and delinquency rates rise. This sort of explains why I think the whole credit game when it comes to consumer credit, not business credit, but consumer credit is getting played out. So this just shows the total debt, household debt. So you have non-housing debt and housing debt. And as you can see, this is just on an upward trajectory. This shows from 2004. And as a lot of you guys know, in 2008 or right around 2008, we had the Great Recession. So we did see a decline in household debt during that period. Then around 2013, it just started to climb, and it's been climbing up ever since. Delinquency rates are rising fastest for low income areas, and these are rates that are above the 2019 level. So this graph right here shows the share of credit card borrowers who are newly delinquent, and it has it disaggregated by income level. So as you can see down here, the light blue is the lowest income, dark blue is the highest income. Since 2021, it started to increase. If we look at this chart, Q1 of 2021 all the way through Q1 of 2023, for all income groups, it's increased, but we see the highest newly delinquent percentage for the lowest income. And that kind of makes sense, right? Because if you have less income, more than likely, if your debt starts to increase, then you're going to be the first to not be able to pay your bills. This is another interesting chart that shows credit card delinquencies disaggregated by the type of debt that people have, right? So basically, credit card delinquencies are going to be highest for individuals who have both auto and student loan debt. So you can see the light blue is for people who have auto and student loan. The red is student loan debt. The brown is going to be for auto debt. And then the dark blue is going to be for credit card only. And then the gray is going to be for mortgages. Now, usually people who are able to qualify for mortgages usually have a little bit more established, financials. And so it kind of makes sense because normally you're not going to get a mortgage, at least in today's time, without certain credentials, right? Credit score, income, debt to income. So that usually makes sense. Usually people who do have mortgages tend to be a little bit more stable. I would also presume that this light blue group is probably going to be younger people, right? Just to kind of paint another picture for you, right? So this pretty much shows the historical consumer loans, so credit cards and other revolving debt from all commercial banks. And this is coming from the Federal Reserve Economic Data. That's what FRED stands for. It's increasing up until, let's say, 2008. The recession officially began, I believe it was, or recognized in the second quarter of 2008. Someone could correct me if I'm wrong. But as we see, it kind of peaks at the end of 2008, and then it decreases for a couple years. And then we see in 2010, it just shoots right back up. And then we're going on this upward trajectory all the way until we get to 2020. So we know what happened here. There was a lot of economic stimulus. And so a lot of people were actually able to pay down their debt. So that's why we see this decrease, right, from March of 2020 all the way until, let's say, about May of 2021. So right here, we see the debt levels actually decrease, right? So a lot of people were able to pay down their debts between March and about May of 2021. And then after May of 2021, we just see this upward trajectory all the way up until, the first quarter of 2024. So over this, let's say almost 3 year period, consumer loan debt has actually increased a lot, right? And so we're still on this upward trajectory. But I did want to just highlight this period right here just to illustrate what this effect actually caused. So when people are able to pay down their debts, that actually allow people to get better and higher credit scores. So again, just take note of this. From March of 2020 to, let's say, about May of 2021, consumer debt decreased because people were able to pay down their balances because a lot of people were getting these stimulus checks. And so what happened as a result of that is that credit scores actually increased. So this right here shows the median credit score. And again, almost sort of the same time period when we're looking at, February, March of 2020, all the way through, let's say, the end of August 2021. So nearly the same period. And we see this upward trend overall when it comes to credit score. So credit scores actually increase from, again, the early 2020 through, let's say, mid 2021. And so going back to this right here, so what happens, a lot of people were able to, let's say, improve their credit, and then that actually allowed them to qualify for additional credit products. And even someone like me who works in the financial services, promoting a lot of these different products, we saw a lot of, high conversions during this time, right? People were getting approved for all types of, credit cards and things like that. So I just wanted to sort of illustrate that, how this, time period, I would say about 18-month time period, early 2021 or early 2020 through mid 2021, consumer debt actually started to decrease and credit scores actually started to increase, which made a lot of people more credit worthy than they otherwise were prior to this period. All right, guys, so this kind of goes back to what I was explaining about the increase in consumer debt. Now, this is the amount of consumer debt based on the type of account. So you have credit cards in blue, you have auto loans in red, mortgages, as well as home equity revolving lines of credit. Just looking at all of these, right, you can see a clear pattern when it comes to credit cards. This has just been on an upward trend. And so the number of credit card accounts have actually increased substantially. So this is the number of accounts in the millions. So let's just go back historically. When we're looking at credit cards, it looks like credit cards peaked in the third or the second quarter of 2008. And then it decreased, right? So the number of credit card accounts start to decrease, still decrease. And then we see kind of a reversal. In 2013, it started to increase and go back on that upward trend. And again, that coincides with what I just showed you in the chart. And credit cards have increased ever since, right? All the way up through the fourth quarter of 2023. Let's go back a little bit further. Let's say from Q3 of 2019 all the way through Q4 of 2023, that's over 100 million new credit card accounts. So again, as you can see, consumer debt when it comes to credit cards has exploded over the past 4 years. All right, so this chart right here shows the transition into serious delinquency, 90 plus for credit cards by age. Now, delinquency started to peak for the younger age group. It looks like more like the first quarter of 2008, and then it started to decrease, right? This kind of yellowish line. This is age group 60 to 69, and this age group actually represents the most financially stable age. And as you can see, when we look at Q1 of 2023, the lowest in terms of transitioning into serious delinquency is going to be the age group of 60 to 69. So it's pretty self-explanatory that the younger group, 18 to 29, are going to experience higher delinquencies. Usually, you have less income in that age range. And then also in the 30 to 39, right? People are still kind of, trying to figure out their financial situation, maybe starting to get into their careers. And then this brown line right here, which is 40 to 49. And you can see there's a big gap between the 30 to 39 and the 40 to 49, right? The 40 to 49, usually you're going to be a little bit more settled into your career. Maybe you've had enough time to build up your savings. So you're going to be a little bit more economically resilient. Then you have the 50 to 59, again, a little bit more settled, right? And then ironically, you have this 70 plus that is the next group. And the reason why I think this is not 70 plus is usually that's after retirement age. So maybe people's incomes will actually decrease, which might make them less economically resilient. And then we have this 60 to 69. And again, this was what I was saying is the most economically resilient group. When you think about it, 60 to 69, if you did have a family and children, they're probably grown up now. So a lot of the expenses that you might incur from raising a family, probably not going to have those same types of expenses once, your children have moved out of the house. These are probably also people who are probably at the top of their careers, right? Maybe they have, senior level positions. They've had a long time horizon to save and invest and things like that. So looking at the current trend, we saw what happened in 2008, right? So then we see a decrease in delinquencies, obviously, because a lot of people weren't really accessing credit. And then around 2013, as you can see, it started to increase again because a lot of people started to have access to credit. And then we see in 2020, right, this first quarter, delinquencies decrease. Again, we had stimulus money. People were able to pay down their debts. There were a lot of forbearance programs in here. And then we see in Q1 of 2022, the delinquency started to increase, right? Right now, where I see we're at a point where I think we're hitting another peak in terms of this economic cycle, right? Now, looking at this is also just with the auto loans, right? And it pretty much follows the same trends as the credit card delinquencies. The younger age cohort, the 18 to 29, have the highest, followed by the 30 to 39. And I think, between this, let's say 50 to 59 and 60 to 69, there's definitely a transition. I think the 50 to 59 probably still in that working age. Maybe your children are growing up, you having more expenses, college tuitions, higher food bills and stuff like that. But it seems like there's usually this transition between, that 50 to 59 and 60 to 69 where the expenses are probably going to decrease and probably less economic pressure. Also, let's say you're just growing further into your career, you have longer time horizon to save money and invest. So you usually see a little bit more resiliency in this 60 to 69. And they're probably not taking out as much debt either, right? Maybe they have a paid off house, paid off cars already. And so, less things, less expenses to rack up and so forth. Now, overall, again, I think there are some changes that are about to occur, especially in the personal finance credit space. And this is probably going to, again, affect the lower income, lower credit quality types of consumers. We've seen an uptick in defaults. Consumer debt is at an all-time high. We have a lot of delinquencies that are rising both in credit cards as well as in auto loans. So this is an alarming statistic, and I think a lot's going to change. We're already seeing a tightening in the lending space. Again, as I've referenced just from my anecdotal evidence and things I see behind the scenes, is that conversion rates are going down. Banks are tightening underwriting. You're having also a shift in the types of verification and data that's being used for lending decisions. So back in, let's say, 21 and 22, even in 2020, when credit was more readily available, there was a lot of just soft pull approvals, no doc types of loans. All of that is beginning to change right now. You add the fact that there's a lot of fraud going on. The lending space is definitely tightening. And I think if, let's say, you're marketing to sort of the subprime credit types of borrowers, then it's going to be harder to convert. And I would say in that area is definitely going to be a recession, right? These different products that are geared towards the subprime market, that's going to be hard to come by, right? So if you have poor credit right now and, you know, unverifiable income, getting access to more credit is going to be extremely difficult right now. So I just wanted to share this information, share this data with you guys. Anyways, let me know what you think in the comments section down below. And until next time, take it easy and we'll talk to you soon. Peace.